This is the McDonald's Extra Value Meal. McDonald's just brought it back this festive season, but it isn't a Christmas thing. They brought it back because low-income consumers can no longer afford to eat, even at McDonald's. But at the same time, American Express cardholders surged over the festive season. America alone is about to spend a record $1 trillion on Christmas for the first time in history. There's a problem emerging across the world. The same Christmas looks very different for the rich and the poor. We're not having one Christmas anymore. We're having two, and the gap between them is wider than it's ever been. So today on the Capital Desk, let's talk about how Christmas spending trends are foreshadowing some of the greatest inequality ever seen in modern history. McDonald's isn't alone. Across the world, executives are describing the exact same phenomenon. They're seeing a consumer base that's splitting in two. Coca-Cola's chief operating officer, Henrique Braun, told investors on their October earnings call, "We continue to see divergency in spending between the income groups. The pressure on middle and low-end income consumers is still there." Chipotle's CEO says lower-income guests are further reducing frequency of visits. The gap, he says, has widened. Mondelez, the company that makes Oreos, reports that value-seeking consumers are increasingly turning to discounters and club stores. These are executives with fiduciary duties to shareholders. They're not speculating. They're describing what they see in their sales data every single day. So what does this split actually look like at Christmas? Let's start with what the season looks like if you're doing well. American Express CEO Steve Squeri told Bloomberg that spending among Amex cardholders over the Thanksgiving holiday increased 9% compared to last year. 9% growth among a relatively affluent customer base. Delta Airlines announced that revenue from premium cabin seats is expected to exceed coach next year. CEO Ed Bastian says he's seeing no signs of slowdown in the expensive seats. None. Hilton reported that their luxury brands are performing exceptionally well. In Britain, Next, the fashion retailer that's become a bellwether for the UK high street, exceeded its Christmas forecasts and raised profit guidance. Its shares jumped 9%. For this group, it's a very Merry Christmas indeed. Premium is thriving. The customers who can afford to spend without thinking are spending more than ever. But Christmas for everyone else doesn't look this shiny. The Wall Street Journal recently reported on how managers at hair salons across America noticed that regular customers, the ones who came in every 6 weeks like clockwork, has started coming less often to save money on haircuts. They all say the same thing. "I can do with my hair an inch longer." They're not making a fashion statement. They're saving $30, $40, money they need for Christmas presents. In Britain, the picture is even starker. Shoppers are trading down to own brand products, buying less, stretching further. 69% of UK consumers started their Christmas shopping by August. Not November, August. They're spreading purchases across 4 or 5 months because they can't absorb the December concentration. British shoppers are 4 times more likely than Americans to start Christmas shopping before July. That's not enthusiasm. That's financial necessity. Economists have a name for this phenomenon. They call it a K-shaped economy, where one group rises while another falls, diverging from the same starting point. It tells us that the economy is splitting in two. The chief economist at Moody's, Mark Zandi, found that 49% of all American consumer spending now comes from the top 10% of earners. Nearly half of everything Americans buy, from groceries to Christmas presents, is purchased by 1/10 of the population. Morgan Stanley's Lisa Shalett called the situation completely wackadoo. The top 40% of households control 85% of America's wealth. 2/3 of that wealth is tied to the stock market, which has climbed 90% in 3 years. If you own stocks and property, you're on the upper arm of the K. If you don't, and the bottom 50% own just 1% of the market, you're on the lower arm. And the distance between those arms is accelerating. So when you hear that America is having a $1 trillion Christmas, or that Britain will spend £25 billion, those numbers are real, but they're also misleading. Holiday spending grew 4% or 5% in nominal terms, the raw increase in money spent. But when you account for inflation, the actual growth is nearly flat. More money is changing hands, but roughly the same amount of stuff is being bought. For budget consumers, it often means the same purchases costing more, or fewer purchases altogether. And here's what makes this Christmas different from previous years. According to Deloitte's annual holiday survey, 57% of American consumers expect the economy to weaken, the most pessimistic outlook since they began tracking in 1997. And yet, record spending. The paradox isn't actually a paradox. The wealthy say they're worried but spend anyway because they can afford to. On the other hand, the struggling say they're worried, spend anyway because of social pressure and the emotional pull of the season, and then carry the consequences for months. PwC has tracked this pattern in the UK for years. Consumers consistently spend more than they say they will. One year, British shoppers predicted they'd spend £20 billion on Christmas. They actually spent £23 billion, 15% more than stated intentions. The emotional pull of the season overrides financial prudence. But the consequences of that override aren't equally distributed. And that brings us to how the lower branch of the K-shape is actually financing Christmas. Because a lot of that spending isn't coming from savings. It's coming from debt. According to Morgan Stanley, the 30-day credit card delinquency rate in the U.S. has hit 5.3%, the highest in 11 years. Credit card balances are growing twice as fast as incomes. Subprime auto loan delinquencies have reached their highest level since 1994. This is the starting point, even before Christmas 2025 data has been collected. And then there's buy now, pay later. On Cyber Monday alone, finance transactions hit over $1 billion. Adobe projects the total for this holiday season will reach $20 billion, an 11% increase over last year. Klarna, Affirm, Afterpay, ClearPay, they're not just payment processors anymore. They're the infrastructure of leveraged Christmas. In the UK, the Financial Conduct Authority has been issuing warnings specifically timed to the festive season. They've noted that loan fee fraud was one of the most reported scams last December. The regulator knows that financial desperation peaks at Christmas, and so do the people who exploit it. Here's the number that should really stick with you. 23% of Americans were still paying off debt from last Christmas in May. Not January, not February, May, almost half a year later. These are the same consumers who are charging up another holiday season with even more debt. The trillion-dollar Christmas isn't being paid for by savings, it's being financed. And the bill doesn't come due in December, it comes due in January, February, March, when the festive glow has faded and the statements keep arriving. For the upper K, holiday spending barely registers. Asset appreciation continues. Life resumes normally. For the lower K, it's payment plans, stretched budgets, accumulating interest. The celebration becomes a burden that extends months into the new year. Now, you might think this is just commentary, but here's what Jerome Powell, the chair of the Federal Reserve, said at the October meeting of the Federal Open Market Committee. If you listen to the earnings calls or the reports of big, public, consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products. But at the top, people are spending at the higher income and wealth. He's describing the two distinct economies operating in the same country. The Federal Reserve typically focuses on aggregate numbers, GDP, unemployment, inflation. They don't usually break things down by income bracket in public statements. So when Powell explicitly acknowledges that the economy looks fundamentally different depending on where you sit in it, that's significant. And it's not just the Fed. The Bank of England has been grappling with the same tension, trying to cool inflation without crushing consumers who are already struggling. Corporations are also adapting to this split. They have to. Take McDonald's and their extra value meal being reintroduced. Take Hilton and the fact that their luxury brands are thriving while Hampton by Hilton, the budget option, sees revenue declines. Or take Coca-Cola. On their October earnings call, leadership described pursuing affordability and premiumization simultaneously. On one side, they're pushing premium products, Topo Chico sparkling water, Fairlife protein shakes. That's where growth is coming from among affluent consumers. On the other side, they're introducing mini cans, smaller portions at lower price points, affordability for those who need it. When Coca-Cola, the company that built its entire brand on universal appeal, on being the same product for everyone, starts splitting its approach by income bracket, it's telling you something that GDP numbers won't. So how did we get here? Lower-income households have always been more vulnerable. They spend a higher percentage of their income on necessities, so price increases hit them harder. And after each recession, they tend to fall further behind. But something accelerated after the pandemic. During COVID, some people saved substantial amounts of money. There weren't as many opportunities to spend, stimulus payments arrived, and asset prices rose. Other people's savings were depleted entirely. That divergence hasn't corrected, it's compounded. In Britain, Barclays reported that UK consumer spending fell 1.1% in November, the largest decline since the pandemic. The Financial Times reported that retailers were exasperated by the October budget, which introduced higher employer national insurance contributions and minimum wage increases just as they entered their critical trading period. The structural pressures aren't easing, they're intensifying. But this matters far beyond Christmas. Morgan Stanley's Lisa Shalett has been warning that she sees genuine cracks for mid to lower-end consumers. These cracks are causing the economic outlook at top institutions to be increasingly fragile. Research from Oxford Economics shows that lower-income households have a much higher propensity to spend additional income than wealthy households do. When a lower-income family gets an extra £100, most of it goes back into the economy. When a wealthy family gets the same amount, much of it gets saved or invested. Put simply, broad-based economies grow when broad-based spending increases. When only the top tier is driving consumption, you've got a structurally fragile system. The wealthy can pull back on a whim. They have options. The economy becomes dependent on the sentiment of the rich rather than shared prosperity. So let's return to those headline numbers. America will spend $1 trillion on Christmas this year. Britain will spend £25 billion. Milestones. Records. But what do those numbers actually tell us? They tell us total spending. They don't tell us who's spending. They don't tell us whether that spending comes from wealth or debt. They don't reveal how many people are stretching and how many are comfortable. The trillion-dollar Christmas is real. But the prosperity it represents? That depends entirely on which arm of the K you're standing on. Christmas is, in many ways, capitalism's annual stress test. We concentrate a huge proportion of retail spending into 2 months. We stress supply chains to near breaking point. We pressure consumers to spend regardless of their actual capacity. We create social expectations that override financial reality. And in doing so, we reveal exactly who has money and who's pretending. The K-shape exists year-round, but Christmas makes it visible. The wealth gap becomes undeniable when it's measured in deferred haircuts, August shopping, and financed presents. Procter & Gamble's CFO, Andre Schulten, described the current environment as probably the most volatile I've seen in a long time. More consumers are waiting for the best value and best promotions. And it's not just lower income, even middle-income customers are showing the same patterns. The middle is hollowing out, and Christmas is where that becomes impossible to ignore. Remember where we started. McDonald's, the company synonymous with affordable food, bringing back value meals because lower-income customers can't afford to eat there anymore. The CEO didn't say this to make a point about inequality. He said it to explain a business decision to shareholders. It was an involuntary confession about the state of the economy. And it's a confession being repeated by executives across the developed world, from fast food to airlines to consumer goods. They all see the same thing, a customer base that's splitting in two. This December, 2 Christmases are happening simultaneously. One where spending is effortless, where premium experiences are booked without hesitation, where the market gains of the past 3 years translate into generous gifts and comfortable celebrations. And another where every purchase is a calculation, where presents go on payment plans, where haircuts get deferred, where shopping starts in August because December is too expensive to bear alone. Same stores, same decorations, same carols on the speakers, completely different realities. The trillion-dollar Christmas is real. The 25 billion pound Christmas is real. But the prosperity those numbers represent? That depends entirely on which economy you're standing in. The K-shaped Christmas isn't a prediction about the future. It's a description of right now. In America, in Britain, across the developed world. And the gap between those two lines is getting wider every year. When the value option isn't affordable anymore, the economy has told you everything you need to know. Thank you for joining us on the Capital Desk. We'd love to hear your thoughts in the comments. If you enjoyed this video, drop us a like and subscribe for more videos explaining the structure behind the stories.